Hello and welcome to Beaky Primer. Very good afternoon to all the viewers. One stock that is in focus on the back of earnings is Chalet Hotels. The stock is seeing gains of almost around 3.5% in trade, and this is on the back of the numbers that have been reported. Overall, if you go to see, the revenue margins are below what the street was estimating. The PAT has beat estimates, and this is on the back of a deferred tax asset of around 58 odd crores. But overall, a good set of numbers that have come in on the top line as well, with a 22% growth. The EBITDA has gone up by around 7 to 8%. And if you see in terms of the margin, the street was estimating somewhere around 42.84% versus a number that has come in at 35.3% versus a 40.27% in the previous quarter. To decode more, Sanjay Sethi, MD and CEO at Chalet Hotels, joins in. Sanjay, good afternoon and welcome to the show.
Good afternoon, it was a pleasure being here.
Always a pleasure to speak to you as well. Sanjay, my first question coming to you is overall, has the quarter met your internal expectations?
It has, because I just want to put some numbers in perspective here. Once you say that we had 35% EBITDA, there are a couple of one-off events that have caused that to happen. Once we opened a new hotel last month, and when you open a new hotel, the carried forward costs before the opening get sort of entered into the P&L of the hotel. And therefore, that 57 million rupees or 5.7 crores got piled on to the operating costs for this quarter. The others, we had to pay some GST expenses of about 107 million, which is 10.7 crores. So combined together, these are almost about 16.5 crores, which it reflects in the numbers that you mentioned. The way I look at it is the following. Our consolidated revenue was rupees 3.1 billion, which is a 21% growth on the similar quarter last year. And our adjusted EBITDA, adjusting for these two events that I spoke about, or costs that I spoke about, is actually 1.3 billion, which is a 24% growth on the quarter one of last year. And that results in about 40%, 40 plus percent EBITDA margin. In the hospitality segment, for example, we had a 23% revenue growth on the back of 38% growth in average room rates and 30% growth in room revenue as a whole, leading to an EBITDA of rupees 1.1 billion, which is an EBITDA margin, adjusted EBITDA margin of 42.5%. And if you don't adjust for that, it is 40%. So overall, I think we've met our expectations. In fact, at 42.5% EBITDA for hospitality division, it's quite a good performance. So yes, I think we're on the right track.
Sanjay, as you took us through the numbers, the way you look at it, now, if we exclude the deferred tax asset of 58 odd crores, the profit number then comes to be very flattish. What's the reason for that?
So if you exclude the deferred tax asset and you exclude the GST payment, which is for historical part of it, which is, and then 5.7 crores for the hotel assets, the growth in PAT is still quite significant.
Okay. And what numbers are you tracking on that front when you say significant? Because the previous quarter number was 28.5 crores.
Yeah, so previous quarter is probably not a number that you'd look at. I think the number that you would probably look at is actually quarter one or FY.
Correct. That one is 28.5 crores.
Yeah. So coming to that, our profit and loss for the year last time around was 28.6, and on an EBITDA of 100 and sorry, let me just get the numbers right here. We had an EBITDA of adjusted EBITDA of 1.3 billion. So that's 100 that's about 13. Yeah, so that's about 13 crores. And 30 crores EBITDA minus interest. Yeah, so we are roughly around 8 to 10% higher than last year.
Correct. So apart from that, if you see in terms of the occupancy, because the hospitality business has seen a good margin growth that has come in. But if I look at the occupancy levels, at around 70% versus a 78. Any reason for that?
So last year around Hill, we had the IPL business, which was
Hmm.
centered and concentrated around around Mumbai only. So all our three big hotels had three teams from IPL staying with us. As a result, the occupancies were higher.
Hmm.
Um, and I think that reflects on the rates also. The fact that we got 38% rate growth clearly shows that we did not have large group movement. The other thing is we've been a little selective about the segments that we sort of sign up now, knowing that the rates are climbing very rapidly. So we've been a little more conscious of not taking low-paying crew segment, for example, especially domestic crew, and other low-paying segments. So as a result, RevPAR as a whole is I think about 23 or 26% up, which is a significant growth. And RevPAR is actually a balance between occupancy and average room rates, and the right metric to look at.
Right. Moving on, let's look at the under construction assets, right? Whatever is in store right now, what's the kind of returns you're expecting it to generate at an EBITDA level on the capital that has already been invested?
So a large part of the capex that we've invested in is in the two office assets.
Hmm.
And we expect the IRRs, project IRRs to be in the range of 20% plus. And ROCs to be in the high teens. Then there's some couple of hotel assets. The Hyderabad one that we recently opened. We've got around a Delhi asset that's under construction. We've got 88 new rooms at Pune, 130 rooms coming up at Bangalore. And we'll have the Airoli Hotel, which is a Hyatt Regency. Combined together in our feasibility studies, we were expecting to hit mid to high teens in terms of project IRRs and equity IRRs in excess of 20%. But with the markets improving and the rates improving, we expect that to go northwards from there onwards.
Okay. And on the capex, as you mentioned, on hospitality front, we're already expecting around 3,770 rooms by FY26, which is almost a jump of around 35% from a 2,802 rooms currently. You're looking at Novotel Pune, Marriott Bangalore, the Duke's Retreat, DIAL, and Airoli. Now, the reason I am coming to this question is that this is a time the industry, yes, is in an upcycle, but a lot of hotels are looking at an asset light strategy, whereas Chalet strategy is absolutely the opposite, to own majority of it, right? So what's the reason for this strategy, and how we, I mean, what is the entire rationale behind it?
So completely on a lighter vein to begin with, I mean, if we don't build hotels, where the asset light company is going to sign new hotels from? But having said that, I think it's held us well in the last few decades. Your returns are high, and typically the value of EBITDA or revenues from a single hotel that you own is so much more higher than asset light business that you tend to have step ups and jumps every time you open a hotel, as against having small and steady climb ups. As an outcome, I think we've stayed true to our core strength, which is owning and building assets. Having said that, it doesn't mean that we will not look at operating our own assets also. In fact, we're already operating three assets. As we go forward, the Delhi Hotel and the Hyatt Regency Airoli will be all managed by us on a day-to-day basis, which is a step forward for going asset light at some point of time. We haven't sort of firmed up anything, so don't assume that this is our confirmation that we're going for the asset light part of the business. But we continue to explore that option. As I said, we want to be on a rapid growth path. It cannot come through asset light today, but sometime in future it could be the path forward.
Absolutely. And I think to take the shape of what the market wants is absolutely crucial as well. Thank you, Sanjay, so much for joining us on the show and sharing those views. And clearly, the markets are taking the numbers well. The stock is up almost little over 3% as we speak. So that's the management of Chalet Hotels. That's all that we have on this session. Thanks for watching, and lots more lined up on the other side. Please stay tuned to BK Prime.